In between the recency bias of an upbeat property market and the conflicted interests of market commentators oblivious to the dead cat bounce lies a strung-out property investor. Will interest rates decline significantly soon, sending house prices to the moon? I'm not so sure. Welcome to the Everyday Investor. Today I'm testing my dead cat bounce theory on Kiwi Bank's chief economist, Jarrod Kerr. If you want to know what that is and what it all means, stay tuned. Let's get started. You're listening into the Everyday Investor podcast. Passive investing, property investment, managed funds, and crypto. If you're an everyday person wanting to build new wealth for the new world that you're heading into, then this podcast is for you. I'm Darcy Ungaro, your host. I'm a qualified financial advisor, but I'm still learning how to invest better and teach others how to do the same. I talk with guests and cover a range of topics designed to get you to think for yourself here. But please keep in mind, this can't be considered financial advice. Be sure to do your own research here and seek qualified advice of your own before making investment decisions. If you want more information, check out the show notes in your podcast player and make sure that you've subscribed to YouTube also. Then follow the Everyday Investor on all social media channels. The NZ Everyday Investor podcast receives support from the following partners: Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand; Gorilla Technology, increasing business success through innovative and strategic IT solutions; Ungaro & Co. Financial advice for everyday people building everyday wealth. Hope you enjoy the show. Let's get started. Most of us tend to focus on the micro or the macro. Focus on climbing up the corporate ladder, balancing the budget, worrying about the kids, and keeping up with the Joneses. Or do the other thing and consider the bigger picture. Economic indicators all screaming red, geopolitical standoffs with no real solutions, and societal shifts we're pretty sure the majority aren't in fact into. All the while, our media, our politicians, and our institutions sing the same old song, nothing to see here. While there's every financial incentive for financial advisors like me to preach the merits of dollar cost averaging and highlight the green shoots that occasionally sprout up, I have to say it, we're not in fact out of the woods yet. Banking on property gains showing up over the next 12 to 24 months, hoping to sell at a higher price than today? I hope that's going to occur, but that doesn't make it likely. Looking back over the last 50 years, though, property values double every 10 years, more or less. I wouldn't suggest that the rule's broken here, but I would suggest some extreme volatility with property and equity markets in both directions could be in store. Let's frame it for the everyday investor first, though. If you're making your first significant financial decision and you have the means, aim to own your own home. It's a home that you're buying first and foremost, right? But it's also an investment. Some feel strongly that it shouldn't be, but it doesn't change the fact that it is. Own your own home if you can, though, because one way or another, it's going to set you up well for later on in life. The next step, though, well, consider investing in managed funds. Use a retirement or superannuation fund like KiwiSaver here in New Zealand, and then build up a portfolio of private and public companies. Consider mainstream investments like this, but don't forget your insurance strategy. Buy other investments that conventional thought steers you away from, like Bitcoin. And yes, invest in even more property too if you can. For the long haulers, while there's tremendous value in being strategic around the design of your investment portfolio, just do something and do it regularly over time. Because the best way to afford tomorrow's life is to start funding it today. Back to the topic at hand, though. While some might think a few paused rate decisions by the Reserve Bank of New Zealand and upbeat immigration data against the backdrop of strong unemployment data signals the property market's bottom, I'm not entirely convinced. I'm concerned that many investors might be riding a wave of false hope caused by commentators with a vested interest. If you're looking to trade up to your next property, or you're looking to get into the market for your first time, move when it's right for you and don't worry about this stuff. If you're making assumptions that the market's going to return to what it once was in the next 1 to 2 years, though, Just remember that the broader context does in fact matter. I hope you enjoy this conversation today, so let's begin. My theory is, and this is where I need you, Jarrod, to help correct me. My theory is that this could be a dead cat bounce situation that we're in right now.
Yeah.
And to define that, and by the way, we're starting, to define that, a dead cat bounce is a temporary short-lived recovery of asset prices from a prolonged decline in a bear market, which is then followed by a continuation of a downtrend. So when we look at the property market, interest rates go up, property prices go down, often with a lag. My observation is that there's a lot of hopium out there in the market. A lot of people kind of looking at maybe the Reserve Bank dropping interest rates. That should ignite some fire within the economy and enthusiasm again in the housing market returns. But in my view, I feel like it's a short-lived bout of enthusiasm. Would you agree with that, or are there holes in my argument there?
I think there is a lot of that out there at the moment. A lot of investors, property owners that we've been speaking to in recent months have been really sort of grasping for, hope, and any signs of activity are seen as green shoots. And I think we're still a little way away from, putting the stake in the ground and saying, this is the bottom and this is where it's going to recover from. But I think the true litmus test for the housing market is going to be spring and summer, and how we play out in the next 6 months. Based on what interest rates are doing, it does look like we're finding a bottom. Interest rates have risen a little bit recently. We're hoping that they have peaked. Where they go to from here is pivotal for the market. If they stay high for very long, then that is going to continue to suffocate the market for as long as they remain high. Our view is that the next move is a rate cut, and we're kind of hoping that the Reserve Bank's in a position to do so in May next year. If we're right and the next move is a rate cut, then that will help fuel the property market. So we are calling a recovery next year in the housing market. But you're right, it could be one of these sort of dead cat bounces for a while. But then I think interest rates will ultimately drive it. The demand supply dynamics in the housing market are pretty clear. We've got a chronic shortage. Demand is surging with the surge in migration. So that sort of demand versus supply, as supply is coming off, will provide some support to the market as well.
Yeah, obviously a lot of visibility around data, especially immigration, and you would have seen that coming through. When people come to New Zealand, what is the typical sort of lag? Like how long does it take for people to actually buy a home? Because that wouldn't always be instant, would it?
We know that most migrants turn up in Auckland. I think about 95%, but then they spread out afterwards over varying time frames. As you say, some would buy a house, within a month or two of landing. Some might take a couple of years. Some might just rent the entire time that they're here. Either way, they're adding demand to our market. Whether they're coming here and taking a rental or buying a property, that's an extra person. And we've added 80 odd thousand migrants in the last year, so that's a big jump. And if there's sort of 2 to 2.4 people per household, that's an extra 50,000 homes that we need just for the migrants that we've let in over the last year. And we've already got a shortage of, it looks like about 80,000 homes. So adding to that, and at a time where builders themselves have lost confidence, a lot of builders that we speak to, they're busy now, but they're kind of worried about their order book, what's coming. So the number of consents has eased back quite a lot. Building activities come off quite a lot. So supply in the housing market's come off, which is, unfortunate, because the solution to our housing problem is not playing around with the demand side, which is what policymakers do. It should be, stimulating the supply side. We need more homes.
And inflation, which is
Yeah.
part of this equation, driving up building materials specifically means that maybe the types of homes that these new arrivals will be buying, assuming they do buy a first home style home, that's now harder to create, that way harder to create, that way more expensive. So what does that say? Like, does that mean that immigration will actually be a boost to kickstart the building industry that needs to bring new housing online, because they probably don't have a reference point of how cheap it used to be to buy a home here?
Yeah,
Maybe they
yeah.
might be more willing to pay the higher prices.
So if they're coming here with large wads of cash, then like you say, they'll just buy what they like, and that's fine. Most of these people come from a much higher density background, so
Yeah.
they're much more willing to live in a high density dwelling. We need to build more high density dwellings in this country, because the demands there is that slow cultural shift. We're a lot more Asian now, so there is that higher density demand out there.
Yeah.
But I think your point was really good. The the fact that it costs so much more today to build a home. There's a premium on new properties, because they're just so much more expensive to build, and that affordability problem is getting worse because of the cost of building, interest rates and income and all that other stuff. But that cost of building aspect is something that we really need to tackle as a nation. I think there's a hand to be played by government in trying to create more affordable dwellings.
Or even just removal of some of the red tape that increases the cost of actually getting things done, right? That's got to be a factor. So interest rates, in my mind, again, it goes straight back to the heart of the issue in my mind, which is that if the cost of money is lower, then people will be able to borrow more money, and generally they're going to be borrowing that money to go into housing. Therefore, you can kind of look at where house prices will go by seeing where interest rates go. So your forecast would suggest by May we might start to see some cuts by the RBNZ.
Yep.
All else being equal.
Yep.
What would be some of the situations that you would expect that would cause a decrease sooner?
Getting the results that we want sooner. So seeing inflation fall faster than what we're anticipating. And unfortunately, there's some frustrations around that. Internationally, inflation's fallen quite a bit, but then, petrol prices, oil prices have gone up recently, so that doesn't help. Our currency is weakening, which is great for exports, but that doesn't help with imported costs. So there's a few things. I think we will be importing a bit of deflation in the next year. So prices
Could you explain
out of China.
how that works? Yeah. Well, you
Yeah.
probably would, actually.
So prices out of China are falling. Global growth has slowed quite a lot. Our trading partner activity is a lot lower than what it was. Global inflation's simply gone from 10 point something percent to 7-8%, which is a step in the right direction.
Yeah.
In the United States, has gone from 9.1 to 3. That's a fantastic result. We kind of hope that we can get that here.
Yeah.
We're reasonably comfortable inflation will be at 3%, sooner rather than later.
Yeah.
But it's getting it down to 2%, which might take
Right.
a little longer and might be a little bit more frustrating. So
Mm.
China is the big risk for us. I think if their economy fails to recover, we will get sooner rather than later rate cuts here. But then if inflation simply proves to be more frustrating, then rate cuts will be something of a more distant conversation.
Yeah, because China is starting to, well, it certainly appears like it's unraveling faster than we thought. Like we thought maybe post lockdown over there would be this splurge of excitement and a lot of economic activity. But we're seeing kind of like a continuation of the Evergrande dramas in terms of defaults and potentially risking contagion of some sort, I suppose. And if they go into recession, they buy less milk. Is that effectively the theory, right?
Exactly right. We cop it directly with our trade to China. So less of our exports go to go to China. We can diversify as much as we like,
Yeah.
and we need to do. I think strategically as a country, we need to diversify away from China. But directly a slowdown in China hits us through, as you say, dairy, forestry, all these other exports, and it also hits us indirectly via Australia. Australia's exports go to China as well. That China's our number one trading partner, and it's Australia's number one trading partner. And the coal, the iron ore, all that stuff that Australia digs out of the ground, the demand for that starts to evaporate. Increases in export prices, say dairy, goes to the farmers, and the farmers spend it on utes and fencing and whatever. There's kind of a direct link. Whereas in Australia, that money ends up in BHP's bank account or Rio, and Australians enjoy whatever increase through their super, but they're not getting the same direct benefit that Kiwis do via our farmers.
I see. Okay. So we're kind of living in this bizarro world, I guess, where bad is good in the context of China again. So if China continues to have a shocker, that's going to really impact what's happening in New Zealand in terms of our exports and the revenue coming in, which might then cause the RBNZ to decrease the interest rates potentially sooner and potentially deeper. Is that what we're saying?
Yeah, definitely. So if China fails to recover, there's going to be a lot of stimulus thrown at the economy. But if they fail to reignite, then we're going to get rate cuts here sooner rather than later. But that's it's calling for rate cuts for the wrong reasons, right? You don't really want that.
That's kind of
happen.
what we've been dealing with for like the last two series of rate cuts. It's been the Christchurch earthquakes, March 2020. And so it's kind of like the market is now primed to be optimistic and bullish when we see really bad things happening offshore. It's crazy, right?
Yeah, well,
it shouldn't be like that.
You're right. I mean, you look at equity markets, when you see some bad news, sometimes interest rates fall on the back of that, and the equity market's like, oh, lower interest rates.
Yeah.
That's good for equities.
Yeah.
But over the longer term, that's not really the case.
Yeah, it's strange, eh? So I think it was October 2021, we moved off of that 0.25% OCR.
Yeah.
18 months later, 5.5%, which was May of this year, 2023.
Yeah.
I was reading up a little bit about Milton Freeman and Anna Schwartz. They were doing a study, or they did a study way back in the day around the lags between monetary policy and the macroeconomic reality. So you change the setting, and it just takes a while for that setting to take effect. And somewhere around that 12-month mark seems about right. So that's why I was interested to hear that call around May 2024 in terms of a decrease, because that in theory would be when the maximum pain would be felt on average from that peak OCR setting. So I guess one of my questions to you around that would be, well, even since the beginning, it kind of felt like they went too hard, way too fast, in my view. Like it just felt like it was just too much. Do you feel like they're going to overshoot and they're going to really, really mess up our economy because that leg still hasn't really fully kicked in?
Yeah, you're right. I mean, there is some science to what we do, and looking at those lags are key. And to put it in New Zealand's context, it's slightly different wherever else you look. But in New Zealand's case, most people take out fixed rate mortgages, right? So 10% of our book is variable on people on variable mortgages. The other 90% people on fixed rates, and they generally fix between 1 and 2 years. Those seem to be the sweet spots, depending on how people are feeling, basically, and where banks are pricing those rates. So we've got a lag of somewhere between 1 year and 2 years, and sort of kind of seems to be a bit in the middle. So those rate rises that started, as you say, in October 21 and really ramped up over 22, they're still coming through. We noticed in pretty much October, November last year that these interest rate increases were starting to have a meaningful impact. And we started noticing it on our credit card data, our debit card data, all the transactions that go through a bank. Working for a bank is super cool. We have some awesome data, and it's obviously high frequency, daily data, and we see stuff and we see things change, quite rapidly in real time, and they were changing last year. So we changed our call, and we said the Reserve Bank is likely to do too much. We were seeing this bite straight away.
Yeah.
Reserve Bank kept going, as you say, and hiked to 5.5% in May. We think that may have been a step too far. We basically took that last rate rise and we looked at the complete lags going through and said, well, they could be cutting as early as February, probably most likely May next year. And then when you look at previous RBNZ cycles, they tighten, they get to the peak in the cash rate, and then it's about on average 9 months later that they're cutting. So they don't stay on hold for long. They've either done enough, and if they have done enough, then the next move is a cut. And when is that coming? That's the discussion that we need to be having. They themselves are saying, well, we're not sure we're finished. To be 100% clear, we're not 100% certain that we're finished. There may be another rate hike. We disagree. So that's where we are in the discussion now, and the debate, amongst commentators in New Zealand is, have they finished? And once we've established that they're finished, then I think people will be pretty quick to start calling for rate cuts.
Okay. Do you feel like I'm just imagining the Reserve Bank? They are looking like a pilot flying a plane. They're looking at these gauges all the time to see what these various settings are telling them about their scope for further treatment on the economy, to inflict further pain on the economy. How much can it handle? And they would look at indicators like, well, obviously inflation, but employment is another piece in that puzzle, right?
Yeah.
Because this touches on a concept called the Phillips curve, where there's, correct me if I'm wrong, an inverse relationship between the unemployment rate and the inflation rate. Hopefully I got that right. So if they are cranking up the interest rate and they can see that the unemployment data still looks really good, then it's kind of like telling them it's a green light, right? Like, hey, people aren't suffering too much. People are okay. They're not losing their jobs yet. Is that kind of how they use that?
You're absolutely right in that we use the Phillips curve. The central bank uses the Phillips curve. They've got a dual mandate, which is the Phillips curve. Maximum employment or minimal unemployment on one side and inflation on the other. That is your Phillips curve, invented by a brilliant Kiwi, nearly 100 years ago, by the name of Bill Phillips. Yes, we use that. So they are lifting interest rates to slow the economy down, and they'll always talk in that term, in those terms. What they do need to see is a loosening in the labour market. They actually do need to see the unemployment rate lift because of that relationship that you talk about. You have a very tight labour market. Wages have accelerated over the last year or so. That acceleration in wage growth, that becomes self-fulfilling with inflation, self-reinforcing, and you do get this inflationary issue. So they're really trying to knock that on the head. It's hard for them to come out and say we've lifted the cash rate, 500 basis points in order to lift the level of unemployment in order to reduce inflation.
Yeah.
But effectively, that's kind of what you're doing. You're trying to slow the economy down to loosen things up. And we've had a very tight labour market. Now, again, going back to my conversations with our business customers late last year, it came early in my thinking, but we had businesses turning to us late last year saying we're starting to downsize.
Interesting.
And I was like, wow, that's early, and these were they were builders, they were developers, there were various businesses out there, but particularly the ones in housing market were turning around saying, we're actually going to reduce our staff. Now, at the time, most conversations that were being had, up until that point, were around the inability to find staff.
That's right. Yeah.
So everyone was complaining, can't find the staff. having to pay a whole lot more just to retain our staff.
Correct.
That was the problem. Now all the surveys are showing what we heard late last year, and that is actually businesses have gone from complaining about labour being their problem to complaining about future revenue being their problem. They've gone from worried about trying to find workers to actually worried about their order book. What are their sales likely to be in a year's time? That's a big shift for me.
Yeah, so it's kind of like a early indicator, a leading indicator, which is anecdotal, but
Yeah.
that's kind of showing that we're getting really close to that unemployment piece. And thinking about where we are and our proximity to Christmas, which always seems to be the time that people choose to let staff go. Happy Christmas. Like, I just kind of worry that maybe this Christmas could be particularly acute in that area.
Yeah, I mean, you talk about lags, and there are lags everywhere. So there are lags with interest rates. So you hike the cash rate today, and it takes a year, 2 years to come through. You see a change in activity today. You see things starting to change, the economic data starting to shift. You'll see that show up in the labour market numbers 9 months later, on average.
Yeah.
So people do actually hold on to workers for as long as they can.
Yeah.
Businesses hold on to workers. You don't want to let someone go only to then need to rehire them 3 months later and retrain and all that sort of stuff. So you keep your staff for as long as you can, right? But we're at that point, I think, now where actually people are starting to be laid off. We'll see more of that. We will see our unemployment rate rise. It has lifted a little bit already, but I'm talking about rising from 3.5 today to 5.5 in a year's time. So that's a loosening in the labour market. That points to a bit of disinflation, bit of pullback in wage growth.
Pardon the intrusion on this riveting episode. I thought I would jump in here to tell you to build new wealth for the new future we're tracking towards. That's going to require strong personal finance foundations. New Wealth Foundations is an online personal finance course written for the wealth builder in mind. We've recently updated some of the lessons, and we've added a few new ones too. Before you go ahead and start investing willy-nilly, think about what you're doing and why you're doing it too. Check out the course now and use promo code SEPT, S-E-P-T, for September, and you'll get 20% off New Wealth Foundations and the Home Buyer's Blueprint. Check out the link in the show notes and sign up today. Let's get back to it. I guess the other thing with looking at the gauge of the unemployment rate is, does it actually tell the whole story of the pain? Because where I sit, I hear pain right now a lot. Biggest expense of most households, the households I speak to, are is the mortgage expense, and that's gone up phenomenally this year, and there's a lot of pain going on. So people would potentially go out there and get a second job, right? And so how does that distort the unemployment data when people are working more than one job? Because it's not necessarily saying that the economy is struggling and therefore people are losing their jobs because businesses are struggling. It's more like, no, things are just so expensive. People have to combat that by working way harder than they used to. So how does that get filtered out somehow?
The data that we have is far from perfect, but as long as it's consistent over time, we're kind of happy. It's about how things move over time.
Yeah.
And it's interesting that you say you're seeing a lot of pain out there as well, right? I mean, that you're yet another person who's plugged in and seeing quite a change. So to me, that just that's just another voice who's spoken to many other voices out there. Things have turned. We look at the unemployment rate. There's job seeker data. There's both sort of that hard. I can count how many people are receiving a benefit, and then I can take a survey of households and ask them, are you working and do you want to work? Do you have enough hours? And so the unemployment rate is kind of helpful. The more helpful number is the underutilization rate, which is an economist's way of saying there are people who don't have jobs and there are people who have jobs but actually need more hours. We'll sort of add those together. how many people are out there that actually want to work more. That's a better read, and I think we'll start seeing that loosening up a
Okay.
bit.
Yeah.
So your comment around how do these people, they you might have one job, and 2 years ago that was enough. All of a sudden you need two jobs.
Yeah.
You sort of go into that underutilization
Okay.
bracket, right?
Right.
You may you find yourself needing more hours to get by, so that'll be picked up
Yeah.
in that underutilization rate. I think we will see that deteriorating, more,
Yeah.
and for two reasons. One, people will need to work more hours because of the cost of living crisis, and two, I think there will be a pullback in the hours people
Sure.
are working. So businesses, the first thing they do is cut your hours rather than your head count.
Yeah.
Um,
Yeah.
yeah, I remember during the
That's
'08
right.
crisis, I was working for the Commonwealth Bank of Australia at the time, and they came very close to implementing a forced, Friday off. They were going to get us to work 4 days a week rather than five,
Right.
and they came very close to doing that across the whole company. So, that was their first response.
With the Reserve Bank, again, just thinking about them flying the plane and looking at these settings, they're not necessarily looking at increases in the arrears of credit card payments or mortgage payments. Would that be correct?
Oh yeah, they look at
Oh,
all
they
that.
look at that as well.
Oh, absolutely.
Yeah.
Yeah,
Because that
absolutely.
would obviously,
That
I'm just
is,
guessing that would be telling them some interesting things right now too.
yeah. Again, there's a bit of a lag in that data as well, because banks will help people out
Yeah.
for as long as we can. We would do anything we can to stop someone from defaulting. Right,
Totally.
that's the absolute last
Yeah.
thing. So we'll put you on interest only. We'll put you on deferred payments. We'll do all sorts of stuff. So that will postpone. But if you can't find a job after, I don't know, 6 months,
Yeah.
then people default, right? And there's
That's
nothing
right.
you can do about it.
Yeah.
When you see that spiking up, there is a very strong relationship with the lift in unemployment and defaults.
Yes.
Obviously,
Of
people
course.
lose their jobs. There's not much they can do
Yeah.
thereafter. So defaults, like I say, are lagged. They kind of show you things. They kind of show you what was happening a while ago.
Yeah. Yeah. What
Um,
about interest rate increases and defaults then? Because on the basis that mortgages are way higher than what they like, mortgage balances
yeah.
are way higher than when we were at 5.5% OCR last time back around 2008. So like that could be a potential catalyst to default on a mortgage rather than losing your job. It's just that the expense on your mortgage is too much. Is that measured?
Today we've got more debt than what we had going back, like you say. So we're more interest rate sensitive. So every
Yeah.
rate hike hurts a little more than in the past.
Yeah.
Banks do stress tests. We do test rates.
That's right.
You come to us for a mortgage. Doesn't matter what the mortgage rate is. We will test you on a much higher rate. And a couple of years ago, we were testing people on 6.5%,
Yeah.
which
Yeah.
at the time seemed really
That's
high
right.
compared
Yeah.
to a 2% or 2.5% mortgage rate that was being offered at the time.
Yeah.
Here we are at 7.
Yeah.
So there are
Fascinating.
people that have been tested at 6.5 who are now facing 7% mortgage rate. So yeah, you're right.
Yeah.
There are people out there that are clearly, struggling
Yeah.
with that level of debt that they've taken on
Yeah.
recently.
And they can hold their breath for only so
Oh, you
long,
can,
right? But if the interest rates stay at this elevated state for longer than ideal, people have to come up for air. They have to breathe, and that might mean that death, divorce, and debank, right? Those are the three Ds that we often kind of joke about. But
mm,
debank hasn't really been a feature in terms of causing pressure to force people to sell their homes for quite a while.
mm.
Usually rates constantly kind of trending downward over the long term. So I guess the longer we stay at these elevated interest rates, the more likely that debank would actually be the primary driver in forcing a large cohort of people to sell potentially all at once, even.
I think we would need to see, the lift in unemployment, quite a substantial lift in unemployment,
Right.
to see that. Income growth has picked up as well. So if you have
Mhm.
got a job, you've probably received a good 5 plus% pay rise in the last year. So that kind of helps, although inflation, has been higher than that. But
take some of the sting away, though,
it
right?
takes a little bit of the sting away. And, we are talking a very small percentage of people, but you're right, there is a risk that, these higher interest rates force people or some people to sell, which, obviously very unfortunate if that takes place. But, I hate to be brutal about it, but from the Reserve Bank's perspective, it's the part of the medicine that they think the economy needs to take.
And that's not, like you said, it's not like they are going to come right out and say, we want people to lose their jobs and potentially sell when they're in a really, they want carnage, but they're not going to say that.
No one wants that.
Yeah.
But they know full well that slowing an economy down in order to loosen the labor market and get inflation back, there is pain in there.
Yeah.
There are individuals who will be hurt by that.
Okay.
But they're looking at the greater good, so to speak. No one wants to see someone, turfed out of their job and house.
What about the setting? So right now the mandate is 1 to 3% inflation rate is acceptable. Is it possible, and I've seen people overseas kind of increasingly start talking about this, where maybe that window gets stretched a little bit higher, maybe it's 2 to 4% instead of 1 to 3? In other words, if you can't successfully play the game, just change the rules of the game, right? Tongue in cheek.
Yeah.
Do you feel like there's a possibility that we could see that mandate relaxed a little bit? And I'm just kind of thinking about maybe looking beyond 1 to 2 to even 3 years. I look at that and I go, well, surely at some stage there's got to be an AI deflationary situation going on, right? There has to be. So again, you kind of don't want to overshoot, and you kind of want to go easy on yourself and almost accommodate higher rising prices for longer. In my mind, again, I'm no economist, but what are your thoughts on that?
No, I agree on the AI front for sure, and that is a discussion that we will have for the rest of our lives.
Yeah.
You and I will be talking about how AI is changing the world, every aspect of our lives. It will be deflationary. It will be incredibly disruptive. I think it will enhance our lives, but then there are those that will be disrupted by it. Yes, that'll have an inflation impact, but we're setting monetary policy with the next couple of years in mind. So, inflation is higher than we like at the moment. A little bit of inflation kind of helps everyone's debt metrics look a bit better because we do things as a percentage. So what's your debt as a percentage of your assets? And
it works for governments.
It works for governments,
too.
right? It works really well. Your debt gets inflated away. That's not so bad. But inflation generally is bad. It really hurts savers. It hurts households differently. Poorer households, it hurts more than wealthier ones. Will we change the rules, like you say? New Zealand is 1 to 3, kind of target 2. Most countries around the world kind of target 2. The Australians target 2.5. Good on them. They're a little bit higher. That's fine. I mean, it's all kind of within a rounding, really. I think central banks, they know that stable prices is important, right? That's kind of the key to help businesses set, long-term goals and strategies. You don't want 6-7% inflation or whatever. We want it stable. What does stable mean? Do we shift it from a 1 and 3% target to a 1 and 4? Okay, possibly we do. The way we play the game is still the same. I don't think they will change the rules. I think they're kind of happy that 2 seems to be about right. It's how long it takes to get back to 2. We had, don't forget, 10 years of inflation running below.
That's right. Well, they had to induce it. Like if you look at the OCR track, it was going well towards 0.25 before March 2020. So they were obviously trying to induce inflation anyway.
Yeah.
So like it's just fascinating, and it causes me to wonder and ask a really disturbing question: that can they actually influence inflation? Because they really struggled to get inflation up in the past.
Mm,
And it kind of feels like sometimes there's just external forces like technology, full stop, that brings that rate of inflation down anyway. So, like in my mind, I kind of look towards the inflation and therefore the interest rate picture as almost like a series of undulating hills. But then at
mm,
some stage, there's got to be a cliff where the inflation just turns really quickly to deflation,
mm.
and no amount of stimulus can get that back up. And that's like tomorrow's question, right? Like I don't
Yeah.
know what that looks like. Thinking long term, 2025 to 2030, what do you see happening with the inflation slash interest rate story?
Central banks started targeting inflation more in the 80s. The Reserve Bank of New Zealand proudly was one of the first to really sort of stamp their mark and say this is what we're doing. We're targeting inflation, and that helped set inflation expectations, which is an important thing. When you tell everyone that you want inflation at 2%, we all get brainwashed, and we're all brainwashed as economists and businesses. We're told that inflation over the medium term is going to be 2%. So when you ask people, surprisingly, where they think inflation is going to be over 5 to 10 years' time, most people turn around and actually say 2%, which is great from the central bank's point of view. That forward guidance, that inflation expectations being anchored is a key part of what they do,
Mm,
and that's their credibility. So they've done a very good job on anchoring expectations. Basically, since the sort of 90s, the increase in globalization, the rise of China, we've basically seen inflation trending down,
yeah.
over that period. And there was a period after the '08 crisis, that 10 years that we talked about, where central banks, I think, were questioning their ability
Yeah.
to increase inflation. We've seen the Bank of Japan struggle to increase inflation for 30 years.
Yeah.
Geez, are we all going to end up like that? It's a real risk. They've got the oldest population on the planet, so there's a bit of a blueprint
Mm,
there. And central banks definitely were worried about their ability to produce inflation. And I think one of the criticisms of '08 was, we had this monetary policy response. We didn't have a fiscal government response to the '08 crisis. So central banks were pushing and pushing and pushing, lowering interest rates, trying to stimulate. Governments were actually, more focused on austerity measures, cutting spending at precisely the wrong time. They're good at doing things at precisely the wrong time. Now, we've got a pandemic where every government in the world found it very easy to start increasing spending in relation to a health crisis. uh, no one no one pushed back because it was a health crisis. It was very severe, and we needed the governments to come in and support. That support's gone on for too long, obviously. But the combination of having both government and monetary policy stimulating at the same time has generated a massive bout of inflation. Oh, so we can produce inflation if we throw enough money at it. It just has to be the monetary policy side supported by
mm,
fiscal policy, and together, geez, it's a powerful combination. So I think we've learnt from the pandemic. You get government spending at the same time the central banks are printing money and lowering interest rates to near zero or negative. Geez, that's powerful. I think
mm,
they've learnt that, okay, we can
mm,
increase inflation. A lot of the inflation that we've seen has been supply driven, but we have seen quite a sharp demand driven increase in inflation as well, on the back of crazy amounts of stimulus, trillions of dollars globally
mm.
printed and thrown into economies.
So, so once we get over this global inflation problem, and maybe I'm being naive to even suggest that we can get over it because we haven't even talked about the rest of the world yet, which is the massive elephant in the room. But once we get over it in some way, maybe the government maybe the fiscal and the monetary get together and there is a legitimate and transparent need to increase government spending and create new money for infrastructure projects. Is that kind of what we would potentially expect from 25 onwards, maybe?
I would love to see more of that thinking. I would love to see more thought around, setting up longer term vehicles, funds that can go out, get their own, issue their own debt, do their own financing, both private, public, working together on our infrastructure needs. We have an infrastructure deficit, which is an economist's way of saying we haven't spent enough on our infrastructure, our roads, our rail, our all of the above. I would say it's a disappointment, but it's also a bit of a disgrace, how little we've spent. So anything that puts more money into infrastructure spending is I'm all for. The fact that I think central banks and governments, have just proven yet again that when they do work together, they can be very powerful force
Yeah.
in the economy, and they'll know that for future.
Yeah.
So we're in a situation now where the government really should be reining back on their spending because the Reserve Bank's trying to slow things down.
Yes.
So if they were working a bit more together today, we might not have as higher interest rates. And then, in the future,
Yes.
if we do have a big downturn or whatever, then having them both work together.
Yeah. Correct. So it's almost like the fiscal is creating a mess that the monetary is mopping up at the moment.
At the moment, there's, I think spending, as a percentage of total and is a bit much. And it's hard to rein a lot of things in, but that's what should have been done. The less the government contributes to demand, the less the Reserve Bank has to try and squash demand.
Exactly. Okay. So if you were to guess then, like bring it back down to today, thinking about the relationship not only between interest rates and the rate of inflation and the rate of unemployment, but thinking about interest rates or the OCR, the official cash rate, and the relationship between rising or falling property prices, what would you suggest would be a neutral OCR?
The neutral rate in New Zealand is somewhere between 2 and 3%. So call it 2.5% if you like. The Reserve Bank currently estimates it at 2.25%. It is a rate that you can't see. It is a rate. It's a theoretical rate, but what it tells you is that the cash rate at 5.5% is well above 2 or 2.5%. Right? It's well above. So we know that interest rates are restrictive. We know that interest rates are reining in spending. They are weighing heavily on confidence. Equally, going the other way, which we did in 2020, slashing interest rates below 2.5%, and towards 0 becomes very stimulatory. And having a cash rate of just 0.25%, which we did have, was very stimulatory, and it proved to be stimulatory. So
I was very stimulated during
yes, so was I. I was very happy with my mortgage repayments at the time, and
fantastic.
Yeah.
In fact, whenever the price goes down, it was quite interesting. I found this really quite fascinating when working with people when they were refixing their mortgages at these cheaper rates. People generally didn't value the savings that they were getting on their mortgage in the same way that they hate the increase. So it's some sort of weird, well, it's not weird, it's loss aversion, isn't it?
I actually think so. Part of that, what you're picking up there, is people will pay the same amount. So you might be paying, I don't know, $2,000 a month on your mortgage, and the interest rate drops from sort of 5 to whatever.
Yeah.
People will still choose to pay the 2,000, and they know that they're paying more principal.
Yes.
So I guess you don't feel it. If you do that, you're obviously not taking the cash.
That's right. Yeah.
You're just hammering your mortgage, which is great. Hammer your mortgage.
Yeah.
Pay more principal when you can, but then the other way, obviously, when you are actually out of pocket, you are
Yeah.
actually paying more on your mortgage. So I
Yeah.
think what you're picking up there is people just smashing their mortgage when they can, and that's great.
Potentially, yeah. And
Potentially,
there
yeah.
is obviously a cohort that will just take
Mm,
pocket the savings and
no doubt,
increase their
yeah.
lifestyle, and then they're the ones without that flexibility for when things have gone the other way, which we didn't see things going this far. Uh,
No, definitely not. The
no,
interest rates rose much. They rose probably about when we thought, but they rose a lot further than we thought they would need to go.
yeah, okay. Now,
Yeah,
again, going back to May next year, which is when you call for when the OCR should be peaked out or maybe even coming
yeah.
down. Considering the lag again, when would you suggest we're going to see house prices on average increasing again? Like, and not just a little bit, but like properly increasing
I think by the end of summer.
by the end
I do.
of this
Summer,
summer. Is that
yeah,
right?
this summer,
Do you think
yeah.
people will be anticipating this and pricing that in?
Yeah, I think it needs to be proven. But we've seen in the REINZ data, CoreLogic, whoever else you want to get your data from, we have seen house prices creep higher
Yeah.
in the last few months.
But
And
is
for
that
me,
not
that's
going back to the debt?
psychological.
You don't think
Yeah, it
that's the dead cat bounce thing?
could be,
Yeah,
for sure. I think the true tests will be over spring and summer, because this is when
sure.
things heat up, and a lot more activity in housing over the warmer months. I kind of think that if we see activity picking up, which we're starting to see, and anecdotes from clients, mortgage brokers and that are telling us that things seem to be looking better. It's like, okay, well, once that becomes a
Mhm.
little bit more self
Yeah,
reinforcing, then yeah,
yeah,
I think yes. The economics point to house prices going up because of the demand supply that I mentioned before. If we're right on interest rates, that'll be the key driver.
yeah,
I think the fact that interest rates aren't increasing at a great rate,
yeah,
people have become a little bit more comfortable.
yeah,
So yeah, I think by the end of summer we should be able to
yeah,
say, look, house prices have risen a small
yeah,
but positive amount,
yeah.
and by the end of next year we're forecasting house prices to be up 5-6%.
Okay.
Okay, that sounds not great, but it's certainly
Well, that's positive.
it's positive, and it's
Yeah.
better than it was. And we don't want to go back to those outsized, ridiculous gains that we got. 45% increase in house prices in 18 months.
Yeah.
Yeah, in the year to
Sure.
2021, which was just extraordinary.
So you're really kind of envisioning a world where maybe even this time next year, adjusted for inflation, real house prices are really going up by 1%, maybe.
Oh yeah, maybe flat.
Sure.
Real, not
Yeah.
not much growth
Sure.
at all. Which is kind of what you want.
We need time for the incomes to rise to the occasion where they're now sufficient to qualify under the bank's lending criteria, hopefully with lower interest rates as well, to be able to service the mortgages to justify putting more steam under it. So yeah, I can see that kind of all lining up a little bit.
Yeah, it's this
Hopefully,
kind of necessary rebalancing
yeah,
that I think the Reserve Bank would want to see.
yeah,
You do kind of want incomes to rise at a faster rate than
yeah,
inflation or house price inflation.
yeah. Because it kind of makes sense, right? Like I guess when the inflation happens, it seems like you get inflation in assets first, then in consumer goods, and then in incomes. Uh,
Yeah, which is exactly what we saw over the
yeah.
last few years.
So
Yeah,
I guess the next stage would be like I know a lot of people have had pay increases, but the next stage would be more significant increases in incomes, and hopefully the asset prices inflate, but not too much.
yeah.
And then consumer inflation, hopefully that doesn't change much either. But then we get that new equilibrium, right? That's certainly a good thing to hope for, right?
I think hope was it hopium? I don't like that.
That's right. Yeah.
I think if we were to say, what do we need as a country? What would be the the perfect outcome over the next 5, 10, whatever years? It would be a substantial increase in the supply of affordable homes. So you're getting more $500,000 properties flooding the market, meaning that more Kiwis who want to own a home can get into, their home. That's where we need to get to. It's a supply problem. It's not a demand problem. We tend to target investors as the bad ones. Let's take our interest deductibility away from them. Let's smash them with a bright line test. Let's do this. Let's do this. Well, actually, no. What we need to be doing is stimulating investors, getting them to produce more, new dwellings and
You're talking my
increase
language, Jarrod.
supply.
You're talking my language. I love this. Makes
Well,
sense, though, doesn't it?
it makes so much sense. I don't know
Yeah.
why we can't do it. We focus on demand.
There's probably a certain amount of political pressure there, maybe,
Yeah.
right? Well, not maybe, definitely. But you're right. Like it's all about efficiency, and we got to increase the supply to bring it into equilibrium rather than hammer down the demand, which is really easy. Just get the whole, public on side with how evil property investors are.
Yeah.
Stamp out that ambition. But no, I think it's got to be more ownership around how easy it is for new properties to get online. And with what I hear from developers, the building costs are up 20 to 30%, and the compliance is just insane, which means that $500,000 price is probably now a $700,000 price, right?
What you didn't say, but the step before that was the lack of infrastructure, but beforehand,
Yeah.
right? There wouldn't be a lot of those issues. Was had we kept up our infrastructure spending and made land available.
Yeah.
We think of ourselves as a really small country with we don't have a lot of land to handle 5 million people. Rubbish.
Yeah.
Put a map of New Zealand on top of a map of Europe and see how big it is.
It's pretty decent.
It's a
And
decent
5
sized
million
island.
we used to be. I remember back in the day, it was 3 million people that were here.
Yeah,
But 5 million, yeah, we can start thinking differently now, right?
I think so. We can
Yeah.
put a lot more people
Yeah.
in the land that we've already just designated, without having to, go out into farmland. So
Yeah.
we've got many things that we can do, and I just wish that we would all focus on the supply rather than the demand.
Yeah. Yeah.
Because I think people should have aspirations to own their own home. We shouldn't stamp it out of them just because we don't have enough houses.
Amen to that. Now, you've been traveling throughout the country. I know you mentioned that in August you had an insane August, speaking to business owners of all sorts. Before we finish up, like, what's some of the key insights that you would have gathered from those people?
Yeah, so I did 27 presentations in a month, which is just crazy for me. So you can imagine I was doing sort of 3 or 4 in a day, here and there. So it was great. Got to go around the country, meet many of our business customers. We have some great customers around the country that give you great insights. When you go into some of these regions. And the conversation that I've been having with clients has changed quite a lot in the last year. I sort of mentioned it before. They've gone from being worried about labor shortages and inflation to being worried about the outlook for their business, for their revenue, over the next 12 to 18 months. There has been quite a shift, I think. Most people will love to hear about housing. There's a lot of even small and medium businesses, they want to know what's happening in the housing market, and they're right, because you look at the housing market and the way the housing market performs has a massive impact on our economy. And then you start delving into, well, what are you seeing over here, and what are you seeing over there? Not a lot of concern over interest rates recently, which I found quite interesting. They're kind of comfortable and thinking, the next move's a rate cut, that'll help. More worried about global situations. A lot of talk about the currency and the need for the currency to come off. Just a real different conversation today than what we were having last year. And we talked, probably because I brought it up, but we talked quite a bit about climate change and what that means. So, I sort of say, look, the insurance insurance companies are sort of taking the lead in this space. They have to. We're going to hear of, insurance premiums going up quite dramatically in some areas, and potentially exclusions, which would be quite bad for those involved. We will insure your property or your business, except for flooding, which is kind of exactly the insurance you need. What does that mean from a bank's perspective? Can we put a mortgage on a property that's got these sorts of exclusions? These are conversations that we're going to be having over coming years, and that it got quite a bite from customers. Like, yeah, okay, let's have that discussion now.
People don't connect those dots really. Like they think just climate change. I don't understand why is that relevant from a lending point of view? Well, just take your residential property. If you can't get insurance on it, you can't actually get a mortgage. And if there's exclusions on your insurance, sometimes that's the same answer too. So I guess like ultimately who's going to carry that risk?
Yeah. And I think it was IAG. I hope it was, because I'm about to quote them, that said that there were 20,000 homes in New Zealand that classified high risk today.
Wow.
And it sounds like they had that information before, the floods. I imagine the flooding and the cyclone would have updated that data. We all get given NIWA data. So we as a bank, we're looking at our mortgage book. Where have we got loans in high risk areas?
Yeah.
You can imagine the conversations that will be had around that now, and into the future. So, it is is it a managed retreat? Do we have to, completely rebuild these homes somewhere else, or can we protect them? It's going to be an interesting discussion, and I really feel for anyone who finds themselves in a red zone.
Yeah, that's right. Okay, well, on that optimistic, upbeat ending, thank you very much, Jarrod, for coming in. If people want to find out the stuff that you guys put out, which is what I'm constantly reading the stuff that you guys put out, where can we point people to find out more about some of the research that you guys do, or even just some of the publications that you put out?
You can jump onto Kiwibank's website under the business banking section. There's a Kiwi economics page. You can sign up to get our research directly into your inbox, or you can follow us on sort of LinkedIn and Twitter and these places.
Yeah. Cool. Excellent. All right. Thanks very much.
Great. Thanks.
Cheers.
Thanks for listening into the Everyday Investor Podcast. Like what you've heard, but you want more? Make sure that you've subscribed to our YouTube channel and subscribe to the Everyday Investor newsletter too. The links for everything are found in the show notes that you can access easily by swiping or tapping over the cover art in your podcast player. If you received value in some way, I'd love it if you could take the time to write a review wherever you listen to podcasts. Share it with a friend, or think of our show partners where appropriate. Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand. Gorilla Technology, increasing business success through innovative and strategic IT solutions. And Ungaro & Co. Financial advice for everyday people building everyday wealth. Remember, some investments or strategies discussed on these episodes may result in financial loss. Be sure to do your own research and ideally seek qualified advice of your own before making investment decisions. Hope you enjoyed today's episode, and we'll catch you next time around.